Welcome to Alternative Investments Chat,
where we demystify the world of alternative investments and financing for entrepreneurs and investors alike.
With these discussions, we hope you're more empowered to unlock opportunities in your business or portfolio. I'm Erin.
And I'm Erica. Let's get started. Hello, and welcome back to another episode of Alternative Investments Chat. So if you've ever done any dabbling in alternative investments in your portfolio, went around and played around with some of the things, you've probably heard of what is called the illiquidity premium.
Mm-hmm.
So for those of you who are thinking, no, I don't, you crazy lady, what the heck are you talking about? Don't worry. By the end of this episode, you'll have a pretty good grasp of that concept and how it comes into play with certain investments. Don't worry.
Yeah.
Like always, we got you guys.
Yeah, we got you. And without further ado, let's just get right on into it.
Head first.
When it comes to finance, we know that when we refer to the liquidity of an investment, we are describing how quickly that asset can be sold and turned into cold hard cash.
Yes.
Some examples of investments with high liquidity include stocks, bonds, mutual funds. On the contrary, illiquid investments are very difficult to sell and turn into money quickly. So if you're in a bind and you're needing to liquidate some of your assets, the illiquid assets are going to be very difficult for you to turn into money.
So I like to think of them as pajama funds and non-pajama funds. Ones you can sell in your pajamas and ones you can't, right?
Yes, that's definitely your version of how easy something is.
Exactly. If you can do it in your pajamas, we're good.
Yeah.
If you can't, maybe, I don't know.
Yeah, for sure. But for some, it might not even be possible to sell them, period, at all, for these illiquid assets. If you do manage to sell, you might even be taking a significant discount on the actual investment itself. But most of the time, this money is just locked up away and you can't touch it until after the term has ended.
Got it.
So some examples of illiquid assets can include real estate, private equity and venture capital, collectibles. Are you seeing a pattern here yet?
Yep.
These are basically all things that we have talked about on this podcast. Liquidity is actually a spectrum. So cryptocurrency is more liquid than residential real estate, and residential real estate is pretty illiquid, but it's still more liquid than resources. So there are things that are illiquid, but certain things within the illiquid side of things that are more illiquid than others.
Yeah, people are in the market for a house, probably not a resource.
Yeah, harder to find the buyer.
Who knows though? I don't. With the way things are going, I might be a gambling man here pretty soon.
Yeah,
so,
that'd be cool. Ride a horse.
Watch out, racehorses. I'm here to purchase you. Don't own a home, but I own a horse.
Yeah, there you go.
I don't know how that's going to play
You
out.
can get to and from work.
Do you think my apartment complex would let me keep a racehorse like down?
I doubt it, but we can work on that.
I'll call somebody. Anyway, so most alternative investments in general are illiquid, like you were saying, where there are some exceptions to that rule, however.
Yeah.
So that's why this illiquidity premium is a very popular vocab word in the world of the alts over here.
Yep.
So let's break it down real fast so we can explain what that actually means. So the illiquidity premium, there we go. We're going to get this word every single time.
It's a bit of a tongue twister.
Yeah. So it's basically an additional return that investors hope to receive, but actually most of them are expecting to receive this for investing in an asset that are illiquid or difficult to trade and turn into cash. So those non-pajama funds.
Right.
So you can't just go on in the middle of the night and push a button and sell it. So they give you a little bit of a bonus for hanging on to your money. So here's something to note. The illiquidity premium can also be referred to as the liquidity premium.
Yeah.
Ill and liquid. They both mean the same thing, so don't be confused if you hear us interchange those here on this episode. But I think this brings us to a bigger question. Why would an investor be interested in illiquid illiquid, there we go. Like you wanted to put all the words together today. Investments anyway. So why would you even want to invest in these if you're an investor?
Yeah, that's a great question. For the purpose of this conversation, let's focus on comparing investments in private equity versus public markets, like the S&P 500.
Yeah.
While illiquid assets don't inherently generate more profit, they do offer the potential for higher returns, and most people expect that the returns will be higher.
Yeah.
Investing in private equity is all about building wealth over time, meaning your money will likely be tied up for a while as, hopefully, fingers crossed, your investment is actually stacking its returns.
Yeah.
So this could be considered the opposite of day trading, and day trading is an activity that crazy people do. Not really, but it's definitely a adrenaline rush situation.
Yeah, I was gonna say, sometimes I wish I was a day trader. I feel like I have the
Yeah.
personality to do that on certain days.
Yeah, some people really dig it and do well, but this is where people buy and sell stocks within the same day and obviously are hoping to turn a profit.
Yeah.
Think about investing in private equity or some of these investments like investing in a home, right? You hope that when it comes time to sell your house down the line, you'll be able to gain a profit. It'll
Right.
go up in value, and you'll be able to walk away with some extra money in your pocket and hopefully be able to buy a bigger, better house or go on an awesome vacation or something.
Yeah.
But you aren't expecting for the home to be worth more the day after you buy it,
Right.
or even a year or even 5 years, right? Like sometimes you're not sure when that profit's going to come around, but you hope that over time the building blocks of a nice return will stack on top of each other.
Right.
So let's look at some numbers here. Here are some findings that industry giants found and presented when comparing returns on private equity versus those from public markets.
Okay.
So from Hamilton Lane, this was presented in its 2025 market overview, and this presents findings over the last 10 years. So if you were to invest $1 in various markets, including private equity, S&P 500, MSCI World Index, and private real estate and private credit, okay, that $1 would generate you more profit if it was invested in private equity. That's what was observed.
Okay.
So, in fact, the report stated that that dollar would have grown to $3.96 over 10 years. Now, granted, remember, not a lot of people invest just $1
yeah.
into the market. So multiply that by however much you actually put in.
Right.
But the S&P 500 trailed in behind at $3.51. MSCI World behind that at $2.61, and private real estate and private credit coming in last at $2.14 and $2.12 respectively.
Got it. Okay. So there's also data from Cambridge Associates that actually corroborates these findings from the Hamilton Lane study that you just were telling us about. So their U.S. private equity index and selected benchmark statistics. We're gonna talk about lots of words here today.
Mouthful.
Report published in December of 2022 shows that over the past 25 years, private equity has actually outperformed stocks. We kind of know this, but like we really like having the facts.
Yeah.
So this report actually presents data comparing about 1,500 PE funds, private equity for those, versus the Russell 3000, which is made up of around 3,000 largest U.S. public companies. Okay, so think Apple, Microsoft, Amazon, etc. Those are the companies that are included in those in that
and the Russell 3000.
Russell 3
into the year 3000.
I just think of Andre 3000.
Oh, okay.
Sorry.
That's good.
So yeah, anyway, annual average returns for private equity was around 13.33%, while annual averages returns for the Russell 3000, not Andre 3000, was roughly 8.16%. So the appeal should be obvious by now. The potential for higher returns is enticing, right?
Yeah.
There's a reason why you kind of want to go in this. Well, on top of that, private equity and other illiquid. Sorry, guys, that's what you're going to hear every single
Emphasis
time.
on the wrong syllable.
Yeah, exactly. Assets can give you access to very unique investment opportunities. So think about investing in startups or private debt. These are more complex and intriguing than simply investing in the stock market.
Yeah.
They're funner.
Yeah.
I love always saying the word funner because I know it's not really a word, but everybody says it. It's funner. Then you have portfolio diversification as well. Another thing that we love to talk about here. Illiquid. Here we go again. Illiquid. There we go. That's what. Should we just name this episode "Illiquided"? There we go.
Or change the
whole title is called
terminology.
"Illiquided." Illiquid assets can be less reactive to market changes, as we know, and might help your portfolio keep afloat during those downward market turns. So
Yeah,
again,
right.
they're not tied to the S&P 500, which is that lovely roller coaster that goes up and down, up and down, up and down. In fact, the stocks these last few days have been a crazy roller coaster. I was up yesterday, down, or no, I'm sorry. I was up 2 days ago, down yesterday. I haven't checked today because I don't even care, because at this point it goes up, down, up, down, up, down, up, down. I'm just letting it live its best life right now.
Yeah, nice. Well, I think that there is some concern that illiquidity is bad,
Right.
scary, right? So is it? Well, not necessarily. If you plan correctly, it can be a feature to your portfolio and not a bug. Now, you might be jumping out of your seat thinking, I'm ready to invest in illiquid assets. Let's go. Well, hold on. It's not quite that easy.
Right.
There are precautions that exist specifically for investors surrounding these kinds of investments. So they're not actually open to everyone. Unregistered securities require you to be an accredited investor, which we've talked about a lot on this podcast. But for a quick recap, this means that you need to have a net worth of over $1 million, excluding your primary residence, and an income of over $200,000 for an individual, or $300,000 with a partner or spouse for the past 2 years, and you expect that you'll continue to make that same amount of money going forward.
Right.
Now, this could be a bummer, but these rules exist to actually protect you. Unregistered securities are considered more risky, more complex, and of course, they're more illiquid. The SEC does not believe that these types of investments are a good fit for what they consider unsophisticated investors.
You're exactly right. And it's a protection for you, just in case, because even though there is a rising popularity of alternative investments that's come about, there is a huge debate. Should these protections be reconsidered?
Yeah, it's a great question.
We've talked about this. I follow a lot of what are they called? Just like studies and papers and reports that, I mean, this rule came out in the 80s. So is this still pertinent to today? I don't know. So liquid assets aren't necessarily safer than illiquid. I'm never going to say this word right, so whatever. Illiquid, there we go, assets. And we just know that. So retail investors are turning to the alternative assets that they can access, like cryptocurrency or those ETFs. So again, they're a little bit more liquid than normal. So these assets they're still complicated, however. So there's some risk. And there is other illiquid investments like private equity that you can invest in as well. So why should investors have access to these kinds of investors and not others?
Yeah.
So I'm not here to say like, no, they shouldn't. Yes, they should. I love to invest in all kinds of things, but it's definitely a hot topic in the alternative asset space right now.
Yeah. And actually, it's a hot topic in the White House right now.
Yes.
So on August 7th of this year, President Trump actually signed an executive order titled, and we're going to get this right, Democratizing Access to Alternative Assets for 401k Investors.
What the heck?
Yes, long title. But basically, this executive order explains that most people aren't able to participate in many alternative assets, and therefore they aren't able to benefit from those returns that could help them in their retirement specifically. And so, with this executive order, it states, every American preparing for retirement should have access to funds that include investments in alternative assets when the relevant plan fiduciary determines that such access provides an appropriate opportunity for plan participants and beneficiaries to enhance the net risk-adjusted returns on their retirement assets. Now, that is a very, very long sentence.
Yes, it is. But it's great that you brought this up.
Yeah, I think that it just shows that, democratizing access to alternative investments, which is literally in the title of this executive order. And while this has to do with specifically retirement and utilizing or opening up access to potential investors into some of these assets that they wouldn't have access to otherwise and incorporating them into their retirement plan, I think it just shows that in general, the topic of making alternative investments more accessible for more people is on the top of a lot of people's minds, including the President of the United States.
Yeah.
So very interesting, but we will see how that actually unfolds. Of course, an executive order doesn't necessarily mean it's a law. It has to be, reviewed, and we have to see how this actually gets put into place. But if you keep an eye on the news, I'm sure that some additional info will be coming to us soon, and increased access to alts might be coming your way.
I really hope so, because like I said, it was like in the 80s when all of those rules were put together. Things have changed since then. So we should probably take a look at that and maybe make some adjustments.
Yeah.
Personal opinion, of course.
It's
So
worth the question, right?
Exactly. So let's just say you're willing and able to invest in I'm gonna have to say this every single time when
illiquid.
There we go. Assets. What are some things to keep in mind? So there's practical steps. So you need to match your time horizon.
Yeah.
What does this mean? Only allocate money you truly won't need for that term. Again, if you're without it, are you going to be okay? You're going to be able to pay your rent, your electric bill,
survive,
go
live
out to,
comfortably.
Yeah, do what makes you happy.
Yeah.
Not going on extravagant vacations, but are you able to survive day to day?
Yeah. Or even if you want to do that, if that's a part of your lifestyle.
Exactly. There's nothing wrong with that either. Spend your money how you want to spend your money, my friend.
Only allocate the amount of money that you can to be able to maintain the lifestyle that you want.
Yeah. And then we want you to size appropriately. So don't outweigh illiquids. So there's no one size fits all. We've talked about this many, many times. But in general rules, stay between 10 to 20% on the illiquid part.
Sure.
Keep everything else liquid. Know the terms. My specialty, my favorite one of all time, read redemption rules, lockup periods, and secondary market options. Read that fine print. It's going to help you out to make sure that, let's say you do need to sell that racehorse. How long is it going to take you, right? And then stress test yourself. Ask, if I lost access to this money for 5 to 10 years, again, would I be okay? Back kind of matches the time horizon.
Yeah.
10 years is a long time.
Yeah.
If you think about it, can I go without $50 today? Yeah. Do I probably need it tomorrow? I don't know. I need to get my nails done. So I'm probably going to need that $50 here pretty soon. But in 10 years, I don't know what it's going to look like. So you need to make sure that you're looking at your finances and making sure that you're still going to be okay without that money.
Yeah.
So remember, these are all questions and conversations that are best explored with an advisor, and we highly suggest going that route. Always go. Remember, this podcast is not investment advice. We are simply learning, and it's just a fun way for us to present this information about the finance world and maybe hopefully spark some new conversation with some of our listeners.
That's right. Well, to close, the illiquidity premium isn't a trick, right? It's a trade-off. You give up flexibility in exchange for hopefully higher returns and unique access. So that's the premium that comes back your way, hopefully, as long as all things go well.
Right.
The premium's not guaranteed, however, right? So if your investment goes belly up, it doesn't work out, there's not going to be an illiquidity premium check that's making its way to you in the mail.
Unfortunately.
Yeah, unfortunately it's lost. It's not some sort of, magic thing that you're going to get. And additionally, it's not like if you invest in one of these investments, they're going to say, this is how much your return is, and this is how much the illiquidity premium is. It's, again, not necessarily guaranteed. So if anybody tells you that it is,
dirty G word, we talk about
run
this all the
away.
time, guaranteed. Yep. Anyways, well, with all of this being said, thank you so much for tuning into our episode again. We hope to see you next time.
Thanks for joining us. Stay tuned for more insight on our next episode.
And don't forget to subscribe to continue the Alternative Investments chat. See you next time.
Content provided in this podcast is for informational purposes only and should not be construed as professional, financial, or investment advice. This podcast should not be construed as an offer to sell or a solicitation of any offer to buy any securities. We strongly recommend that you seek advice from a qualified professional before making any financial decisions.